Well, hello, my name is Elina Linderman and I'm here to teach you how to make world's best spaghetti. Okay, I'm joking. My name is Elina Linderman and I'm a tax accountant. I leave taxes, I brief taxes. You know what? You can watch another video. In the very first video, I did an introduction, explained who I am, what I am, and why you should listen to me. In the very first video, I also explained to you why I have chosen to work with this specific company and none other. Please, if you still have questions or you need to refresh your memory, please watch the first video. But we are here to continue our discussion because you want to invest into real estate in Dubai and your accountant just doesn't know what to do with you now. So let's continue. So you transferred your money, you purchased your property. Now what? How do you report your income in the United States? And how do you even pay taxes in the United States? You see, United States has many tax treaties with many countries, but it doesn't apply to you. You know why? There's no tax treaty with United Arab Emirates because they don't have taxes. Also, it doesn't apply to you because most likely you are a United States citizen. And there's a provision in the tax code, it's called saving clause. And it basically says that if you're a United States citizen, your responsibility to pay taxes first and foremost in your home country, which is United States. So how do you report your investment in the foreign country? Exactly the same way as if you were to report your investment in the United States. You will complete Schedule E, it's a form number that is basically built into your tax return if you invested as an individual. In that form, you will include information about your property, address, how many days you've owned such property, and we're talking about for the period that we file in a tax return, which is always a year. So how many days in that period you actually own the property. You will then report your income and all of your expenses. So income, how much did you earn for that period, and whatever expenses you could have incurred. Those expenses could be different, anywhere from paying an agent, because obviously agent is not going to be working for free, to paying an accountant extra fee because you now have to fill out your tax return and worry about extra forms about which you never had to worry about. You can also deduct your trip to Dubai because it's now a business trip. Of course, please do not take advantage of this and use your trip to Dubai as a full-blown vacation where you just spend one day opening a bank account and then you enjoyed United Arab Emirates for a period of 2 weeks and done absolutely nothing more business related. That's not gonna fly. But if let's say you went for a week and you've spent the entire time meeting with realtors, looking at other properties and doing business related activities, even if it's not a full day, but you can actually show that you have spent time there, yes, it is now deductible. And so on and so forth. You can deduct your education expenses. So for example, if you've spent some money going to some seminars and stuff like that, that is also going to be deductible. So basically anything and everything that has to do with your business, because now it is a business. Now, when we're reporting your business, if you for some reason doing it yourself, do not forget about depreciation. What is it and why do we really need to know about depreciation? You see, in my accounting world, we believe that everything with the exception of land loses its value. So obviously that new property loses a value in my world. I understand that in your world it's going to gain money, but in the accounting world it's quite the opposite. We believe that every single property loses its value, and that loss of value is what we call depreciation. We must record depreciation on your tax return, and depreciation actually helps us pay less tax. So how does it work? We take the value of your property. If you invested in a house, then we're going to deduct the value of land. If you invested in an apartment or condo where we cannot determine the value of that land, we're just gonna take the whole cost. Then, if it's a residential real estate, we're going to divide that purchase price into 27.5 years. Do not ask me why 27.5 years. Our politicians do the strangest things, so we don't ask, we just follow the rules. Anyway, we're gonna take that value and divide it into 27.5 years. And now we are deducting whatever amount we get. So for example, if it's $10,000 a year, we're going to take that $10,000 a year and deduct it every single year. That deduction will actually help you pay less taxes when you're filing your United States tax return. So please be sure not to lose all of your documents and be sure to include it in your tax return, because in order to even include it, of course, you're going to need your original purchase agreements and all of the documentation for the purchase of that specific property. Now, you've purchased property, you've placed it in service, meaning it's now being rented out, and you're now earning money. What are your options for those money? You can do whatever you want. They're yours. You can keep them. If you opened a bank account overseas, you can keep it in that bank account. You can move the funds to the United States. It really doesn't matter. No matter what you do, we're simply going to apply a formula. In that formula, we're going to say, how much did you earn? Write your number here. How much did you spend? List all of your deductions here, and what's the ending number. If you get a positive ending number, it will be added to your tax return. If you get a negative number, it could be subtracted from your other income. There are some limitations, but to simplify our conversation today, we're not going to go into the limitations. Just know that there are some possible income limitations. So we simply look at the formula, mathematical formula, to see if you earned money or if you lost money while renting your real estate. We add this to your tax return, and how much tax are you gonna pay? Unfortunately, I don't know. Why is it that I don't know? You see, United States tax code does not have flat income tax for the individuals for that type of income. The higher your income is, imagine a staircase you're climbing, the higher tax you're gonna pay. So because I really don't know, do you have kids? Does your husband or wife work? Do your kids go to daycare? Do you have college deductions and so on and so forth? I cannot even predict how much tax you're gonna pay. Let's leave it with that. Average United States citizen pays between 15 to 18% income tax on a federal level. If you live in a state that also has income tax, or in a city that has income tax, you would have higher taxes. So for example, I live in Florida. My state does not tax me on that. But somebody who lives in Georgia could pay higher taxes. However, your state might have different rules from the rules of the federal government. From the federal perspective, it's going to be taxable. But very often the rules of the state would say that state is not able to tax investments that are not physically present in that state. So for example, if you live in the state of New York, but your investment is overseas in United Arab Emirates, you're not going to pay taxes to New York on that activity because your property is not located in New York. It is located overseas. So you're paying federal taxes and you might or might not be paying state taxes depending on your state's rule. And because there's 50 states, it's very difficult to discuss every possible rule that you might have. Consult your accountant. Of course, we already started discussing moving money. How do you move money? You can move money using wire transactions, or you can move money utilizing crypto. Same thing. You will be charged some sort of fees for wire transaction. And by the way, guess what? It is tax deductible because it has to do with your business. And again, if you're using crypto, we discussed it in a previous video, we have to see if the end result of that crypto transaction was a profit or a loss. Maybe you broke even, but I rarely see that happening. And we will report that specific transaction on your tax return. So we reported your transaction when you were investing money, and then now we're reporting your every single transaction separately. Then you're moving money using crypto from Dubai back to the United States. There's also, again, FATCA considerations. So if you have a foreign bank account in which you have more than $10,000, and if you basically collecting all the money from all of your rental activities in a foreign bank account, please know, you have to report your bank accounts, pure informational reporting, but you have to report your bank accounts in your tax return and possibly with FinCEN. That requirement is not going to go away. So however you specifically will choose to deal with transferring money back and forth is completely up to you, as long as you utilize one of those legal methods. Okay, so we invested into property. We now have such property. We're now earning money from the property. We are now reporting all of this in the tax return. But now there's other considerations. What happens if you want to sell? Now what? Can you use like-kind exchange? Can you not? And what happens when you sell, basically? Stay tuned for another video.